Hello, Accounting 102 students. This video is going to be the sequel to the present value, future value video that we did last week. So what I'm going to do is use some of the numbers we had from last week with respect to bonds and show you how we can develop all of the different journal entries that are required for the issuance of bonds and for the semi-annual interest payments and for bond retirement. So these numbers here we used last week. In this example, what happened? We had a bond rate which was 4% annual. So semi-annually that'd be 2%. We had a market effective rate or yield of 5%, 2.5% semi-annually. So we made the calculation. We said, okay, we have $1,000 is going to be repaid one time, otherwise known as a single sum. And we used the present value factor for a single sum at I equals 2.5, N equals 10. So whenever you go to the present value tables to make a calculation of the bond issue price, the interest rate that you're using is always going to be the market or the effective rate or the yield. Okay, you would not use the bond rate here to discount. Where do you use the bond rate? Over here to give you the cash flows. So this was a one-time repayment of the bond. It's worth $781. And then you have 10 $20 payments semi-annually. And what are they worth? Well, at 2.5%, you would use the annuity factor, present value factor for an ordinary annuity, which is the sum of the single sum factors. We multiplied across and we came up with this number, 956.24. That's for one bond. Okay, so now we're going to play make-believe. We issued 800 bonds. All right, so what will we do upon the issuance of the bonds? Well, first of all, we would credit bonds payable at the face amount, which in this case would be 800 times $1,000, otherwise known as $800,000. Yeah? Okay, now how much did we sell the bonds for? Theoretically, we sold the bonds for $956.24. So I'm just going to take that number and I'm going to multiply times 800. We get $764,000 for the bonds. So we're issuing these bonds at a discount, or in other words, we're selling the bonds for less than $1,000 a piece. So we're going to put that differential, that bond discount, into an account called, you guessed it, bond discount. And we're going to have to repay in 5 years $800,000. So this 35,008 is going to be added to interest expense over the term of the bonds. Okay, now there's two ways of doing it. There's the effective interest method, which is preferred. Preferred by whom? Our friends at the Financial Accounting Standards Board. All right, so in order to do this, I recommend we prepare a little chart. Here's my little chart. We can also make sure our numbers are good. Okay, now what is the carrying value? The carrying value for a bond issued at a discount is the face amount minus the unamortized discount. So at the get-go, the carrying value, regardless of whether you've issued a bond at a premium or a discount, is going to be what you sold the bonds for. So I'm going to take that number from over here, $764,992. Okay, the unamortized discount is the number that we just plugged into this journal entry, 35,008. Now what we want to happen over time is we want the unamortized discount to eventually go to 0, and we want the carrying value to eventually come up to $800,000. So this should be 0, this should be 800. All right, let's see if we can fill this out. The cash, what is the cash? Well, the cash is $20 times 800 every 6 months. otherwise known as $16,000. And that's not going to change. That's going to be the same throughout, yeah? Okay. This is the key to this little chart. Right here, the interest expense. You take the carrying value and you multiply times, I have used EIR for effective interest rate, which is the same thing as the market rate, which is the same thing as the yield. Okay, and what is that in this problem? That's 2.5%. So I'm going to take this number here and multiply times 2.5%. All right, that gives me my interest expense. Now we find the difference between these two numbers. I'm going to take the 19,125 and subtract the 16,000. I get 3,125. Okay, so we're going to amortize $3,125 of the discount. What does amortize mean in English? Well, in accounting it means we want to make this balance go away over time. So what is it? If I amortize 3,125 out of the total, what am I left with? I'm left with 35,008 minus 3,125. Okay, what's the carrying value? Well, there's a couple of ways to do it. One way is, the carrying value again is the face amount of the bonds minus the unamortized discount. So you could say, okay, this is 800,000 minus the 31,000. It gets you 768,117. Okay, you could do it that way. Another way of looking at it is the carrying value is going to increase by the amount of the amortization each time. Remember, this number is headed for what? 800,000. So we could also do this. Let me get the same number, 768,117. Now, if these formulas are correct, and we carry this down to the 10th period, we're hoping against hope that what? We're going to get a 0 in the unamortized discount column. We're going to get 800,000 in the carrying value. There's your whole chart. Okay, it's a beautiful thing. So it shows the math is correct. That number, that 764, is correct. All right, now if we have this chart, all we're going to do is paint by the numbers now. According to this chart, our interest expense is 19,125. This is the effective interest method, yeah? So you use this number. The bond discount is going to be 31.25. That's going to be a credit, yeah? And the cash, well, the cash is pretty much set in stone. That's 16,000. That would be for June 20th. That would be the first semi-annual interest payment and amortization of discount. What would the second one be? Well, you just pluck the numbers right off the old chart again, right? 19,203. The bond discount is 3203. And the cash is the cash. That's not going to change, yeah? 16,000. There you have it. Okay, so you would just follow that format for 8 more periods. Okay, now in real life you'd be making a monthly accrual, but we're not going to worry about that right now. Okay, so now let's look at another thing that could happen here. Let's say that on this date here, on December 31st, 21, we're going to retire the bonds. Okay, let's say the bonds had a call provision which enabled the issuing corporation to reacquire the bonds at a pre-specified price after a pre-specified period of time. And let's say that was $1,040 per bond. That's the pre-specified price. And now at December 31, 21, we're going to make these bonds go away. So one thing for sure, if you look at our original entry, we've got to credit the bonds payable for 800. There's going to be a debit to bonds payable for 800,000. That's got to go. What's the cash going to be? Well, the cash is going to be whatever the facts are, and that's 800 times 1040 per bond. That's got to be a given, that 1040. All right, now what is the bond discount? Well, if the bonds are going away, then the related discount also has to go away, just like property, plant, and equipment with accumulated depreciation. But anyway, here we go. 22,033 is the amount of the unamortized discount, yeah? And, well, we're missing a debit. Well, there's a couple of ways of looking at this. you could just plug the number, get 54,003. That's a loss. Okay, why did that happen? Well, the carrying value of the bonds is 777,967, and we paid how much to make them go away? We paid $832 to make these bonds go away. So we took a rather large haircut on the deal, 54,003. Jawohl? Okay. So that's how that works. Now there's another method for bond amortization, and it's called the straight line method, which, if there's a material difference between the two methods, we're supposed to use the effective interest method. All right. So let's say, what would we do if we're using the straight line method? Well, first of all, let me say this. This entry is going to be the same, doesn't matter which method of amortization you're using. Issuance of the bonds, as the yuppies say, it is what it is, yeah? We come down here. Is the cash going to change? You're thinking, that's a stupid question. I'm not going to answer that, okay? Of course the cash is not going to change. It's going to be $16,000. All right. Now, the bond discount originally is 35,008. We want it to be what? 0 over time. Yeah? So if we're going to do this amortization 10 times, then I want 1/10 of the 35,000 to go away each 6 months. So that's going to be what? 35,008 divided by 10. There you go. Okay. Now what? Well, the debit's got to equal the credits, right? So we're going to add these two numbers together. And what's it going to be in December? It's going to be the same thing. That's why it's called a straight line. Because this number here is not going to change over time. It's going to do this 10 times, which will make this balance go away over time. Now, what if we retired the bonds at $10.40 per bond? Well, this would be the same, right? This would be the 1040 times 800. Okay, 832,000. The bonds payable, that's 800,000, right? So we have to find the unamortized bond discounts because we don't have a chart, right? So there's a couple of ways of looking at this. One way is, let's say, okay, we started with 35,008, right? And then, if we're going to do this December 21, that means how many amortizations have taken place so far? You're thinking 4, right? 2 in 2020 and 2 in 2021. So what would the balance be in bond discount if we amortized 4 times at 3,580 cents? And the answer is, it'd be $21,004.80. Okay, so that's one way of looking at it. Another way of looking at it is, well, this is straight line. You say to yourself, I started with 35,008. If I amortized 2 years already, that's 2 out of 5, that means I amortized 40% of the balance already. So how much is left? And Mrs. C is thinking, 60%, of course, right? I'm going to multiply 21,004.80. Yeah? Okay, either way, that's the unamortized bond discount. And as with the effective interest method, you have to make that go away also, right? So I'm going to just round off 21,005. And I'm going to do the old plug figure routine again. And this time we're taking a $53,000 haircut. Yeah? Loss on bond retirement. If you issue bonds at a discount, and from my readings, apparently that happens about 95% of the time. But regardless, if you issue bonds at a discount, that means you sold them for less than $1,000. And if you pay more than $1,000 to get them back, which is typical if you have a call provision, that's a year's worth of interest to $40 there. You're automatically going to have a loss. There's no way that you can have a gain. All right. The only way you can have a gain is if you issued the bonds at a premium, and have to be a substantial premium at that. Okay, so you're thinking, well, what about bonds issued at a premium? I paid good money for this class. I want to know about that too. No problem. Let's look at that now. All right, so these are the numbers from the last totally amazing video, right? We said, okay, $1,000 bond. What if the interest rate is 3% on the bonds, otherwise known as the bond rate or coupon rate? Half of that, 3%. These are our cash flows now, right? You got the $1,000, you're going to repay one time, and then you got the interest annuity. Okay, so we said, all right, let's discount those at 2.5%. So we're going to use the same factors. Why are we going to use the same factors? Because we're using the same market or effective rate. We're using 2.5%. And that's what we did last week. And we said, okay, let's take that 781198, that's the single sum factor. And then let's take the 875, which is the PVFOA, multiply it across, and we got this number, 1,043.76. So for this example, let's say that we're going to sell 900 of these bonds, and we're selling them at a premium. We're getting an extra $44 approximately for each bond. All right, so let's come over here. Bonds payable. Well, it's got to be 900,000, yeah? What's the bond premium going to be? Well, all right, let's figure the cash out. We got 104,376, and we're going to get that times 900. We're happy as hell. Why? We got $939,000, but we're only going to have to pay back 900. So that extra money, otherwise known as bond premium, is going to reduce interest expense over the term of the bond. The exact opposite of a bond discount will reduce interest expense. So can we use the handy little chart again? Well, of course we can. And this is the beauty of Excel, right? Because you could see how quickly you can do this. We just need the right formulas, right? So let's take this number over here again. That's what we're selling the bonds for, $939,384. And what's the bond premium? Well, the bond premium is this carrying amount minus the 900. 39,384. Now, what are we expecting to happen with the chart? Well, we're expecting, once again, in this case, the unamortized premium, we're expecting that to go to 0. And if our formulas are correct, the carrying value should go to 900,000. All right, so what's the cash going to be? Well, the cash is going to be based on the bond rate. So I could take this number here, $30 per bond, and multiply it times 900, and I get $27,000. Or I could just look at it as, well, 900,000 times 0.03. So the face amount of the bonds is what drives the cash payout, yeah? So you would not be using an odd number. You'd always be using a multiple of $1,000 here. Okay, so there we go. There's our 27K. What's the interest expense? That's the same as it was last time. Carrying value times the effective interest rate, which is the key to the whole chart. Yeah? Get this number right and we're in good shape. So what's the carrying value? Take the 939,384 and multiply times the market rate or the effective rate, which is again 2.5%. And we get a number. What's the number? 23,485. What's the difference between these two numbers? That's going to be the amortization of our premium, 3515. Now I want this to go to 0, right? So I'm gonna reduce that 39,000 by the 3515. I get 35,869. What's the carrying value? Carrying value is the unamortized discount plus the face amount, which is, and I'll put that over here. Now you can see why I typed this in advance, right? There we go. So it's 900 plus 39. Okay. And which way is it going? It's going down. So another way of doing this column here is to take the 939 and subtract out the premium, the amortization of premium. And that, we hope, now we cross our fingers here, right? We're hoping against hope that this will work out properly. Holy Toledo, it does work. Look at that. Is this the most amazing thing you've ever seen in your life? I know, you don't have to say. Okay, so now let's do the entries. Looks like it already filled these in for me, because I left the formulas in there. Okay, let me get rid of this just so I can show you how I did this. Interest expense is, you guessed it, whatever's in the interest expense column. Bond premium begins with a credit balance. If you want that balance to go away over time, you're going to need to debit that account. So let's debit that account for $35.15. And the cash. Well, the cash is the cash, right? That's not going to change. $27,000. Pull the numbers off the second row, which is December 31/20. Interest expense, $23,397. Bond premium, $36.03, and the cash is the cash. Yeah? Effective interest method. All right, now again, let's play make-believe. These are callable bonds, and the issuing corporation has elected to retire all the bonds on December 31, 2021, which is 2 years from the original issuance. Okay, so let's put our facts together now. We're getting rid of the bonds, right? So that's going to be a debit to bonds payable for $900,000. In these kind of problems, if your debit or credit to bonds payable is not a nice even multiple of $1,000, then there's been some kind of malfunction. Yeah, it should always be a nice even multiple of 1,000. All right, the cash. What's the cash? 1060 times 900. Yeah, 954,000. Okay. Now, if the bonds go away, then the related bond premium must also go. So we're looking at this again, right? What's in this? And of course, I'm assuming that all of the semi-annual interest payments and amortizations have taken place properly. So that has to go, the 24,000, yeah? 24,787 must go. Debit the account, yeah. Now what's the carrying value of the bonds? Well, the carrying value is $924. We just paid $954 to get rid of these bonds. So we took a haircut again, yeah? How much of a haircut did we take? $29,213 haircut. Yeah. Loss on bond retirement. There you go. It's a beautiful thing, isn't it? Okay. I know what you're thinking. What about straight line? You want to know about straight line too? Okay, let's do that. Let's come over here. And with straight line, how does that work again? Well, we say to ourselves, how many times are we going to make this entry? And the answer is, in this problem, 10 times. So I want to take the 39,384 over here, right? And divide it by 10, because we're going to make 10 entries. Remember, this is a 5-year bond, semi-annual, so 10 is the number. For a 10-year bond, we'd be dividing by 20. Okay, so we get 39, 38, 40, okay? What's going to be the interest expense? Now, in this case, you definitely would use the plug the number approach. Debits got to equal to credits, yeah? What's it going to be next time? It's going to be the same thing, right? Straight line. Zip, zip, okay? All right, which brings us to the final journal entry. Okay, we're going to retire the bonds 2 years from the date of issuance. How much cash is it going to be? $954,000. What's the balance in bond premium? Well, let's see. What's the balance in bond premium? We started with 39,384, and then we're going to amortize 39,38, yeah? And what does it come out to if you knock off 4 of those? And the answer is 23,631. And once again, you could use the old shortcut method, right? Take that, and you got 60% of the balance left. Remember, it's the balance you want, not the total amortization. So we multiply 23,630 and 57 cents. Okay? So I'm going to go with 23,631. Put that over here. 23,631. All right, what happened? We had bonds with a carrying value of $923,631, and we paid $954 to make those bonds go away. So once again, we have taken a haircut, $30,369. So there you go. That's a lot of stuff. I know it went quickly, but of course, one of the side benefits of these videos is that you can go back, you can replay a portion or the entire thing. Okay. So there you have it. Now I'm hoping at this point that you can answer the rest of the bond HW problems, which are what? These guys over here. Yeah, und this entire problem here. Yeah. Okay, so have some fun with that and enjoy.